Welcome, everyone. Today, we're going to tackle a really fascinating area of tax law, one that comes up all the time in family businesses and estate planning. We're talking about what happens when you transfer property, say a building or some equipment, to a relative. Now, the rules here can seem a little tricky at first, but I promise we're going to break them down piece by piece so they make perfect sense.
Our main focus is going to be a specific section of the Income Tax Act, 137E. Now, don't let the technical name scare you. Really, all it is a rulebook that lays out how to handle these family transactions to make sure everything is fair from a tax perspective. By the time we're done with this explainer, you'll have a really solid grasp of how this all works.
So here's our game plan. We'll kick things off with some key definitions you absolutely need to know. Then we'll dive into two very different case studies that really show the rules in action. After that, we'll zoom in on the rules for the buyer and wrap it all up with a side-by-side comparison to make sure these concepts really stick.
All right, before we get into any of the calculations, we've got to build a solid foundation. We need to get on the same page with a few key terms. Trust me, once you have these definitions down, the rest of the puzzle pieces will fall into place much more easily.
First up, what in the world is a non-arm's length transaction? You know, it sounds complicated, but it's not. It's simply a deal between people who are related. Think a parent selling to a child or a transaction between siblings. The Canada Revenue Agency basically assumes that you might give your family a better deal than you'd give a stranger, right? So to keep things fair for everyone, there are special rules that apply.
Okay, next up is a depreciable asset. We're not talking about something like stocks or bonds here. We're talking about tangible things you use to earn income, things that wear out over time. It could be the delivery van for your bakery, a rental property you own, or even the computers in your office. Because these things lose value, the tax system lets you deduct a portion of their cost each year. And that special deduction is called the capital cost allowance, or CCA for short.
Now for two terms that are absolutely critical to understand. First, we have capital cost, or CC. Super simple. That's just the original price tag, what you paid for the asset, plus any related costs to get it working. Then you have the undepreciated capital cost, or UCC. Think of the UCC as the asset's remaining value for tax purposes. It's the original capital cost minus all the CCA you've claimed over the years. This UCC number, you're going to want to keep a close eye on it because it's a major player in all our calculations.
All right, let's put these ideas into practice. It's time for our first case study. We're going to follow a guy named Joey, who's selling an asset to his father. And in this case, he's selling it for less than what he originally paid for it. This scenario is super common, and it'll show us exactly how the rules work.
So here are the facts of the case. Joey is our seller, and his father is the buyer. The asset originally had a capital cost of $123,400. Now, over the years, Joey's been claiming his CCA deductions, which has brought the undepreciated capital cost, the UCC, down to $87,323.
Joey agrees to sell the asset to his dad for $53,200. Now, this is a really important detail. For all of our examples today, the transfer price is the same as the asset's fair market value. That means it's the price that two strangers would agree upon in an open market.
So, how does this affect Joey's tax return? Well, we start with his UCC of about $87,000, and we subtract the $53,000 he received from his dad. This leaves a difference of $34,123. And since this is the last asset of this type in his business, that difference becomes what's known as a terminal loss. And this is great news for Joey because he can deduct this entire loss against his other income for the year, which means a lower tax bill.
Now you might be thinking, wait a second, he bought it for over 123 grand and sold it for 53 grand. Can't he also claim a capital loss? And that's a great question, but the answer is a firm no. The tax rules are very specific here. You cannot claim a capital loss on depreciable property. That terminal loss we just calculated, that's the only deduction he's going to get from this sale. Okay, let's flip the coin and look at this from the buyer's side, from his father's perspective. This is where those special non-arm's length rules really shine. You'll see a term here, adjusted cost base, or ACB. Just think of the ACB as the official cost that will be used to calculate a capital gain or loss if his father sells the asset way down the road. So even though his dad only paid about $53,000, the rules say his capital cost and his ACB are deemed to be Joey's original cost, $123,400. His starting UCC for claiming future depreciation, though, is the price he actually paid. This is the key. The tax system essentially keeps the asset's original cost in the family.
All right, time to switch gears. Let's look at our second scenario. What happens if the asset has actually appreciated in value and the selling price is higher than what Joey originally paid? As you're about to see, this flips the script and triggers a totally different set of rules for both Joey and the buyer.
Here's our new situation. Joey's selling a different asset, but this time he's selling it to his mother. He originally bought this one for $87,600, and after some years of CCA, its current UCC is down to $62,246.
Now, the transfer price this time is $92,500. And here is the game-changing fact for this scenario. Notice that this selling price is actually higher than Joey's original capital cost of $87,600. And that one fact, it changes everything. So what does this mean for Joey? Well, he actually has two separate tax hits to deal with now. First, we have something called recapture. It's the difference between his original cost and his UCC. You can think of it as the government recapturing all those depreciation deductions he enjoyed over the years. That entire amount is fully added to his income. Second, because he sold the asset for more than he paid, he has a capital gain, in this case for $4,900. And as you know, 50% of that capital gain is taxable.
Now, for his mother, the buyer, things get a little more mathematical. When the sale price is more than the original cost, we have to use a very specific formula to figure out her deemed cost for claiming depreciation in the future. As you can see, A stands for the seller's original cost and B is the actual transfer price.
So let's plug in the numbers. We take Joey's cost of $87,600 and we add half of the capital gain. This gives his mother a deemed capital cost and a starting UCC of $90,050 for her future CCA claims. But, and this is important, her adjusted cost base, the number she'll use if she ever sells it, is the full price she paid, $92,500. Notice those two numbers are different? That's not a mistake. The rule is designed to limit how much depreciation the new family member can claim.
Okay, we've looked at two pretty different outcomes for the buyer, right? Let's take a moment to pull back and just summarize these key rules. Let's really crystallize what happens to the person who is on the receiving end of these assets.
So the single most important takeaway here is that the buyer's cost for tax purposes is almost never what they actually paid. It really boils down to one question. Was the sale price less than the seller's original cost, or was it more? If it's less, the buyer inherits that original cost for capital gains purposes. If it's more, we have to use that special formula to figure out their base for depreciation. In every case, these specific rules set the stage for all future tax implications for that asset. To really hammer this home, let's do a direct comparison. We'll put our two buyers, Joey's father from case 1 and Joey's mother from case 2, right next to each other. Seeing them side by side will make the different treatments crystal clear.
And this slide really tells the whole story, doesn't it? On the left, with the father, because the price was below the original cost, his tax numbers, both the deemed capital cost and the ACB, are tied to Joey's higher original cost. On the right, with the mother, her deemed capital cost is calculated with that specific formula, while her ACB is simply the price she paid. It's just amazing how that one single factor, the sale price versus the original cost, completely changes the tax reality for the buyer.
So we've gone through the mechanics, we've looked at the numbers, but now I'll leave you with a question to ponder. Knowing these rules, how might this information actually influence a real-life decision? How would it affect the timing, the price, or even whether you decide to transfer a piece of property within your own family at all?
And that's our look at non-arm's length transfers of depreciable property. I really hope this helped demystify what can be a pretty complex part of the tax code. Thanks so much for joining me today. I'll see you in the next explainer. Happy studying.